Well, good morning, ladies and gentlemen. Welcome to a get to know you, and we want to welcome the Howard Neal clients. I'm Jim Cunningham. Connor Clemens is joining me here today. We're going to go through a lot of content. We're going to talk to you about Howard's association with our firm and him with the eye on him retiring. So we want to welcome each one of you. And Connor, would you like to say hi?
Yeah, good morning, everybody. It's nice to have you here. Thanks for joining us today. We're excited to work with you.
Great. So let's get to it. I want to tell you guys that the information that we're providing you here is for information only. So this is not, don't take this and go out and start signing deeds and writing on your trust and doing a bunch of stuff. So you definitely want to do this in conjunction with an expert lawyer, which Connor and I and the rest of the attorneys in the firm happen to be. And so these are the other, speaking of the other lawyers, these are the other lawyers in addition to Howard in the firm. That's Connor there in the upper right-hand side, but we have attorneys in offices in different parts of California, and we are all focused on helping clients preserve their legacy and minimize taxes at every turn. And that is going to be really important going forward, especially as we look at a tax hike. We'll talk about that. We're anticipating an increase in taxes, and we're here to help you guys. So we do have a YouTube page. One of the things that we do is we do communicate a lot. We've been using the Zoom platform for our client meetings. We've also been recording webinars and putting those up on our YouTube page. So I would encourage you, please subscribe to our YouTube page. If you're watching this on YouTube, because this is going to be recorded and put up on YouTube, please subscribe to our YouTube page. That way this will appear in your feed and you can stay informed. So I want to welcome Howard Neal to the firm. And Howard Neal has been an attorney for quite a long time. He's had a great career, lots of experience in estate planning, trust, and probate matters. And we are really excited to have him here. The idea is that he's associating with our firm to essentially wind his practice down and move on to the next stage of his life, riding his bike more, spending time with his grandson. So we're really excited for him to enter this next stage of his career and welcome him with open arms. And I'm gonna knock out some common questions about Howard Neal's association as of counsel with Cunningham Legal and really how it affects you, the client. So will we keep the Montclair Village office? The answer is yes. Your documents are safe with us. Howard did have a document retention policy where he kept the originals, and some attorneys keep the originals and some don't, but your documents are safe with us. They will be continued to be stored in an offsite location and secure. And during COVID, and Connor, I know that you and I have been meeting with a lot of clients on Zoom. Some clients say, I'd really like to meet in person, but we've had to make a difficult decision to conduct as many, if not all of our meetings on Zoom. This is for your safety. It's also for the safety of our staff because we're not out of the woods yet. And Connor, I know I've been having all my meetings by Zoom. Have you been having all yours by Zoom as well?
Virtually all of them, yeah. Signings, of course, we do in person, but anything we can do on Zoom, we do on Zoom.
Yeah. And then we have additional locations. So going from closest to Montclair Village, we do have a San Ramon location, Napa, Roseville, Folsom, Auburn, and then in Southern California, Westlake Village, Woodland Hills, Pasadena, and Huntington Beach. So if you live in one of those areas, we're closer. If you have family or friends in those areas, we can certainly help those family and friends out as well. And I know, Howard, probably the biggest question is, hey, are you guys going to still do free amendments? So we give away a lot of value. We do a lot of free things, but one thing that we do not do for free are amendments. And I got to tell you, I don't know, Connor, I don't know many attorneys that do free amendments. I think Howard was one, and I do know of maybe one attorney in Southern California, but of all the attorneys that we come into contact with, very few do free amendments. And I think, you guys had it good while it was going, but there's a lot of other stuff. So I really would encourage you to check out our YouTube page. We are really big into education. And I would say, Connor, that this is, Connor, you're a little bit earlier in your career than I am. Connor, you've got how many years experience now? And plus your LLM and certified specialist?
5 years.
5 years. So you're solid in, you've been doing something for 5 years. Connor does have his LLM, which is an advanced degree in taxation, as well as he took and passed the certified specialist exam for the California State Bar in estate planning, trust, and probate law. And we do a lot of free stuff. Education, free. Free consults for many things except Prop 19, and we'll talk about that a little bit later. But that's something that we do add value just in a different way. And Howard chose to add value by doing free amendments for his clients, and we just choose not to do that. So one real, okay, here's how we help you. And, we've kind of distilled this down. Most people want to pay the least taxes possible while securing a legacy for their family and loved ones. And we're here to help you craft a plan, give you options, and make recommendations that are part of an integrated plan to reduce your overall tax bill, leading to more wealth for yourself, your family, and your loved ones. Now, I will tell you that in the last 10 years, taxation has not been as big of an issue as it will be in the next 10 years, because everybody, and I'm saying, listen, lawyers, CPAs, people on the street, everybody knows that taxes are going up. The government has printed and stuffed so much money into the economy. One of the ways to keep inflation down is to tax that money out of the economy. So we're anticipating a higher tax rates going forward. So Connor, you want to talk about updating your living trust in your estate plan?
Yeah, and I mean, I do think it's important to note how you just said taxes going up because whatever the government wants to raise revenue or prevent inflation. I think you see some of this attitude that taxes should go up to reduce inequality. And so we're going to talk about Proposition 19 a little bit later, but they just passed a measure. And the whole drive of the measure was to tax those kids of the East Coast elites. That's what they literally put on the ballot. And so that's the type of thing that we're looking for. We look for all these different legal changes, like tax law changes, but also your life changes as well. Like, you have kids, you have grandkids, maybe divorce, maybe marriage. Maybe one of your kids moves away and they aren't in a great position to be your successor, or maybe you move closer to a child. You just have to make sure that you're staying current with the law. This last year, we saw a lot of people worry about going to the hospital or end up in the hospital. You have to make sure that your HIPAA is current, for example. Not everybody has a HIPAA in place. If your estate plan is over 10 years old, you might not have a HIPAA, and that's totally an element of having the proper healthcare documents.
Yeah, Connor, it's interesting. My father-in-law lives about a half a block and fell out of his bed and broke his hip a couple of days ago. He's in the hospital, which is also half a block from our house. And we can't see him. So for those of you who have had a loved one go in the hospital since COVID, you can't go in there. And he's not doing well. And fortunately, we have the document that Connor referenced, which was the HIPAA authorization. That's a document that lets you make healthcare decisions or lets you have access to health information for a loved one, because they're going to have to get the person on the phone and give you permission. And sometimes, people aren't doing so well when they're in the hospital and they really can't give that permission. So it's very important that you look at your estate plan. You should actually review your estate plan, I believe, annually. Every year you should look at your estate plan, and you should look at it with an expert lawyer every 3 years. That's kind of the general rule. Now, I would say if you are wealthier, if you are older, or both, you might want to be looking at this annually, because you are much more sensitive to changes in the tax law. And frankly, your runway is a little bit shorter, and that makes the planning sometimes more challenging. So deaths or births, divorce or marriages, change in finances or health. Many people that we meet with have really done well, frankly, during COVID. They've made more money. A lot of our clients, we have one client who was getting ready to do an IPO. They had a lot of chains of businesses that were severely negatively impacted by COVID and closed, and they're on the verge of bankruptcy. So these people were extremely wealthy, and they've been wiped out. So it's really an uneven journey as we go through this pandemic. But really pay attention to your finances. A lot of you who have real estate or stock market investments, your investments are up. Certainly if you have longer term bonds, your investments are way up, right? So your assets are going up, but then you see the people who don't have money for food, and they're standing in line to get food, and people who aren't paying their rent because they aren't working. So really strange times that we live in. It's a reason to look at your estate plan, because guess what? The laws are changing to adapt to our changed circumstances. So an estate plan, you need to look at not just your living trust, look at your will, your durable power of attorney, your healthcare documents, your deeds. And we do have a Q&A. We're going to talk a little bit about, we're going to answer your questions in a little bit. And so let's ask, are your children protected, right? What do I mean by that? Well, many people, when they pass away and their children inherit, sometimes they're in the middle of a divorce. Sometimes they're in the middle of bankruptcy. Sometimes, they don't want the money. Well, what do I mean? Well, if you have a wealthier child, they say, I'm already wealthy. And if I just inherit this, it just goes on the pile. So you need a plan to preserve this multi-generational wealth. And so you can do that with an outright gift, meaning here you go, son, daughter, here's your inheritance, here's your check. Or you can put that in a protective trust. Connor, do you want to talk about a protective trust and what that is?
Yeah, so protective trusts, these are kind of becoming the default in estate planning, or at least, when people are leaving a significant amount of money to one child. And in our eyes, I'd say a significant amount of money, 500,000, whatever it is that you are afraid to lose, what your child is afraid to lose. When people inherit and they get money in a form of a check, they put those accounts or put those checks in their own accounts. And if they ever get sued or divorced, that money is going to end up being a part of the lawsuit or part of the divorce. So what most our clients prefer to do is to leave money to a continuing trust. And the way that works is it's like an account in another trust. Once you pass away, the money flows in there and the account has asset protection because your child doesn't have to serve as trustee on the trust. Someone else can serve. And the way the trust is set up is that money only comes out of the trust if the trustee says so. So if there's ever a divorce, if there's ever a lawsuit, that's the whole idea, is that your child is not trustee and the money is safe. The money is protected from those creditors and those predators, somebody who wants your kid's inheritance.
Yeah, that's super important. And the other thing now is, how do we avoid reassessment when a child passes away? Prop 19 passed in November, and this law is going to really have some very negative and very serious consequences for children when they inherit property, because most of the property is going to get reassessed. And there is this family home exclusion. I was on a call with the Board of Equalization. It was a public hearing last Thursday. And this parent to child reassessment exclusion of the home is a really skinny, stingy exclusion. And we're going to go into that a little bit later. So, but you do need to pay attention to this. If you have assets, if you own real estate, if you have stocks and bonds, if you own a business, if you have an IRA or life insurance, you really do need to pay attention to what happens after you're gone, because you can't take it with you, right? It's going to stay behind, and it does make sense to protect it. So what about divorce creditors and predators? So getting an up-to-date modern trust. So what do we mean by this? Well, we see a lot of estate plans that are frankly outdated, kind of like an old cell phone. And for those of you who have a flip phone, please don't take offense, right? A flip phone where you just make calls with your phone, but a phone has morphed into, the flip phone has morphed into the iPhone. And for a lot of us, our whole lives are on our iPhone, right? That's how we communicate. We've got email on there. We've got, we actually may be making very few phone calls on our phone. And so the same things happen with living trusts. So people have gotten, frankly, a lot richer. When I was Connor's age, people there wasn't as much wealth. There's a lot more wealth now than there was 20 or 30 years ago. So some features of a modern living trust: a trust protector. That is something that is a modern feature. And if you don't know what that is, a trust protector, you can think of it as a person who has power over the trust, but is not the trustee. Now, that power already exists with the court. The question is, can we take that away from the court? And the judge, you don't know who the judge is. You don't know who the research attorney is. Court's expensive. It's time consuming. A trust protector is a nice hack, for lack of a better term. It's a nice way of getting around having to go to court. I would say, Connor, that trust protectors, they're the default in 2020. Would you say most experienced, competent estate planning attorneys have kind of moved into this realm of 2020 and beyond for trust protectors?
Especially after we saw courts close. I mean, some of them are still hard to get into. So yeah, people prefer to allow a private party to make some of these decisions to clear up ambiguities without having to go petition a court.
And there are some asset protection features, and what we're talking about is asset protection for your kids. And when there's an ambiguity, you might go to sell a property and the title company says, well, we can't issue a policy of title insurance because we think there's an ambiguity in the trust. And like, the client and our firm, we say, well, there is no ambiguity. They say, well, yes, there is. You need to go to court. Now, this doesn't happen that often, but it does happen. And so a trust protector can clear up that ambiguity and get the deal done. And you can think of a trust protector as basically replacing a court. Do you have an AB trust? You know, I would say most AB trusts that were written, and what we're talking about here is right now the estate exemption, the ability that a person can leave anyone is $11.7 million when you die, tax-free. You can actually make a gift of $11.7 million in 2021 tax-free. The AB trust structure was invented or developed in the early 80s when the estate exemption was $600,000. Now, $600,000, I will tell you, Connor, in the 90s, $600,000 was a lot of money. It's still a lot of money now, but it seems like it's a lot less than it was in the 90s. Now that $600,000 coupon has gone up to $11.7 million. And so what we find is many spouses, when one spouse dies, many couples, when one spouse dies, they fund or they put assets in this B trust, and those assets in the B trust are not particularly tax efficient. They save estate taxes, but they often cause capital gains taxes. So that's your sort of the Faustian bargain, this sort of Sophie's choice is, do you pay death tax or do you pay capital gains tax? And frankly, if you've had a spouse that's died, 10 or 20 years ago, that capital, that baked in capital gain can be quite significant. So Connor, do you want to talk about how we terminate a living trust, a B trust?
Yeah. So B trust, I mean, if one spouse is alive and somebody has an outdated AB trust, we just amend the trust or we restate the trust, and we oftentimes make a decision to split upon death, or potentially we decide to just eliminate any possibility at all of splitting upon the death of one spouse. And the reason why is because we can always double the exemption without having to split. Now, if one spouse has already passed away, that B trust is irrevocable, and we can't get rid of it because that first grantor is deceased. We can't just say we don't want it anymore because it's kind of like an agreement that was entered into. So we potentially petition the court. We ask the court to modify or get rid of the B trust in that situation. So if you have that B trust, that's exactly it. We go to court and we get rid of it.
Yeah, and if you're married, if you're alive, it's really easy. You do what's called a restatement, which is a big amendment that replaces all of the terms in the trust. So do you have the right successors? What do we mean by this? So if you can't do for yourself, right? If you can't do for yourself, someone else is going to do for you. Now, this is when you're alive. It's also when you pass away. So what do I mean by that? Well, if you have a stroke, dementia, Parkinson's, Alzheimer's, or whatever it is, and you don't die, so you're still alive, but you're unable to do for yourself, you're unable to manage your finances, somebody else is going to do this for you. This does not happen on itself. This trust doesn't sign checks and pay your bills and collect rent from tenants and file tax returns. Somebody's got to do that. Now, the term that we use for a trust is a successor trustee. A successor trustee is a trustee, but when we say successor trustee, that means the person who is not yet serving but will or may serve in the future if the current trustee is not serving. So that's what that term successor trustee means. And the incapacity versus death, it's important to look at that because sometimes you want different people. You might say, you know what, I'm more concerned about my bills getting paid, someone closer, somebody who can, it's easier to function. But, when I die, this thing, it looks like it's kind of complicated. So I might want to name somebody else to handle that. I might want to name my daughter to help me in Oakland, do all the things I need to do. But when I pass away, I might be naming my son in Berkeley, who's a CPA, right? But he's too busy to help me while I'm incapacitated. And that would be an example of why you might want to consider two different people for what is essentially the same role, but at different times, right? So living versus deceased. And then, you want to talk about the trustee factors, Connor?
Yeah, sure. So I always say there are 4 factors. Competence is a big one. It's great if you have a kid who's totally honest, but if they don't know how to pay bills, it's not going to do you much good. And of course, honesty, that might be the most important. You need someone who's going to do the right thing. Proximity, just like Jim said, a lot of my clients, they have a child who they kind of feel like holds everything together when they pass away, who they have that in mind, but that child lives on the other side of the state or the other side of the country for that matter. They might not be in the best position to help take care of your affairs if you're incapacitated and time is of the essence. And a lot of people tell us, I have 3 great kids and I want to pick them all, or I've heard it's not a great thing to pick them all. What do I do? The person who communicates the best, the person who keeps the peace when people are expecting, distributions or things like that, or to be kept in the loop. That's the person who I'd advise picking, the person who can communicate the best and keep the peace in the family.
Advanced healthcare directive, very important. When you go to a hospital, oftentimes they make you fill out a new one. And I think that is kind of weird, quite frankly, where you go to the hospital and they make you fill out a new one. I've seen this happen with my in-laws. But you should have one handy. The person who's making these decisions, your successor, and an advanced healthcare directive says, look, if I can't make healthcare decisions for myself, my wife makes them, or my children make them, or my child in a certain order. Make sure that's handy. Make sure they have that, because if you can't communicate, if you can't articulate who is to make healthcare decisions for you, then you're going to need to rely on that document. So you might be in a hospital and, we're in this era where you cannot visit people in the hospital. I don't even think you can go inside of a hospital. So, and we don't know when that's going to be over. Is it going to be over in 2021? Is it going to be over in 2022, 2023? We just don't know how long this thing's going to go on. And then also, finally, are your documents scanned and on hand for easy access? When I started practicing in 1994, I started scanning documents. I figured, it's probably a good idea. And I'm really glad I did. One great thing that Howard did, Howard is scanned. I think he scanned all the documents. It's fantastic. It's a great idea because this data is handy. So many times it's, hey, I have a question about this particular page, and you look at it and you can get an answer without having to go order documents from storage. And having it take a long time. So is your trust funded? So a living trust, now I want you guys to understand, a living trust typically holds your savings, your investments, your bank accounts, your real estate, your investment properties, your commercial, your industrial properties, or your LLCs, or however it's structured. It does not hold your IRAs, your 401ks, your 403bs, your TSAs, your life insurance, your annuities. Those typically do not go into a living trust. And you need to make sure that your assets are in the name of your trust. Now, it's very easy. You look at the statement that comes in from the financial institution, and it's going to say, your name and your trust name. You'll see an abbreviation, maybe TR or TE or T or something like that to denote that it's in a trust. You need to make sure that these are in the name of your trust, because if they're not in the name of your trust, it does make things more difficult on the people when it comes time, when you're not able to do for yourself, or certainly when you pass away. You might be looking at going to probate court, even when you're alive, but with a properly drafted and created estate plan that is funded, right? You're going to be in a much better position than if it's not funded. And funding, remember, the trust is a bucket. Get those assets into the name of the trust. Assets do tend to leak out. Now, joint tenancy is a very common way to hold property. Sometimes, for Prop 13 reasons, it might be beneficial, but that is a rare exception. Joint tenancy is typically not a favorable way to hold property, because it's a last man standing or last woman standing gets the property. And many times people don't want that. And then, right, Connor, your successor trustee can only manage what's inside your trust. And how many times do people pass away and there's stuff outside of their trust?
All the time.
All the time.
My big one is that I talk about this with you. I get clients who say, Connor, I have my kids as my POD or TOD on my account. And the big issue there is that might work. That might pass the assets to your kids just fine if you pass away. But if you become incapacitated, trustee is going to have to jump through some serious hoops to get a hold of that account, because it's not a part of the trust until you pass away.
So I mentioned what should not be in your trust. Foreign assets, that does come up actually more frequently than you might think. Assets that are in foreign countries can be problematic. So we typically recommend that people do an estate plan for their assets located in a foreign country. All right, so changing tax laws. The estate tax exemption this year is $11.7 million. If you're married, double it. It's $23.4 million. If you have a $30 million estate and you want to use up your exemptions, depending on the asset, what the assets are, there is a way to compress the value and get that transferred to the next generation. The taxable portion of it transferred to the next generation, the ownership, but you keep control. So we're doing that for a lot of clients. We're anticipating this year for people. And as you'll see, well under 11.7 million, we're going to be recommending that clients consider some advanced planning, because we believe that the exemption is going down. And we're going to talk about the 10 big points in Joe Biden's plan. And I'm going to talk about this completely in an apolitical sense. I'm not politicizing it, but I'm just talking about what he has stated on his platform about what his tax goals would be. But something to be mindful of, the estate exemption, the coupon, the freebie that you can leave 6 million expires January 1 of this 11.7 million expires December 31 of 2025. January 1, 2026, it goes down to 6 million. Now, many of you have a home that's worth 2 million. Many of you have an IRA that's maybe $1 million, and investments of 2 million, and maybe some life insurance of 2 million. You have a taxable estate. You may not feel rich, right? You may be watching the nickels and the pennies and, you know, cutting coupons. You may not feel rich, but you may be classified as rich. And what we're going to see is it depends on how this legislation is written. It may have a really serious negative effect on even very small estates. The gift exemption, of course, is $15,000. What about California adopting its own estate tax, Connor?
I mean, it's always possible, right? I heard we're actually going to have a surplus potentially for 2020, but we'll see if that keeps up. It's always possible to raise revenue. They adopt a state estate tax.
Yeah. So what do you do to prepare now? We're going to talk about that. We're going to go through the Biden tax plan. We're going to go through some strategies that you should be. We want to introduce these to you so you can hear them and get a little bit familiar with them, because many of our clients do use these. Now, I will tell you, these strategies are used currently by very wealthy people, and middle wealthy people are going to start using them, because if they see this new tax plan come out, they go, wow, I really don't want to pay 80% tax. And that's the number. And I'm going to show you how it's 80. Now, before you fall out of your chair, this is not law, but I think it is possible. This is like the extreme of how it could be. So let's talk about the 10 Biden tax plans. I'm going to go through these kind of quickly. You might have heard about these. A higher maximum tax rate to go from 37 back to 39.6 on income above 400,000, but no specifics. Now, do a lot of people make more than $400,000? I mean, some do, a lot of people don't, but you should also understand that when you sell something and realize a capital gain in California, that's added to your income. So if you have a $1 million capital gain, that's just added to your California income tax, and that's taxed at 13.3% at the highest rate. Limiting the itemized deductions to 28%. What that means is, even if you're in a 39.6% tax bracket and you take a $1 deduction, you're only lowering your taxes by 28 cents. So you're only getting that 28-cent deduction. So it's not a 39.6-cent deduction per dollar. This is really important. Hiking the capital gains taxes from 20 to 39.6%. And that is almost a doubling. And this is for gains over $1 million. Now, you may say, well, this is not going to affect me because I'm never going to sell those properties, or I'll do a 1031 exchange. Just wait until you see what the death tax plan is. So that would be hiking capital gains tax rates that would make them over 56% for Californians. Higher Social Security taxes. Right now, there is no Social Security tax above $137,700 for 2020 wages. Biden proposes a 12.4% Social Security tax or self-employment tax on wages above 400,000. So if somebody earns, if you're working at a highly compensated position and you're making $500,000, your Social Security taxes are going to go up $12,400. This is a biggie. Eliminating step-up in basis for inherited assets. This is a biggie. And that's why I highlighted here, going back, that's why I highlighted this capital gains tax, because if you eliminate the step-up in basis, and what we mean by that is, if I die and I bought Apple for $1 and it's worth $3, Apple stock for $1 and it's worth $3, when I die, my wife can sell that $3 stock and pay no capital gains tax. My kids can sell that $3 stock and pay no capital gains tax. Steve Jobs did this. When Steve Jobs died, his wife inherited $450 million in stock. She was able to sell that stock and pay no capital gains tax. So there is no limit on this. And I think that's on the chopping block for the federal taxes. By the way, federal government can pass any law it wants on taxes. The Supreme Court gives Congress extremely broad authority. They say, listen, this is a political decision. We're really not going to. So if you think, oh, it's unconstitutional to charge that rate or charge it in that way, good luck. Biggie, eliminating Section 1031 exchanges. You want to comment on that, Connor?
Yeah, they've been talking about that forever. I mean, the last Tax Cuts and Jobs Act in 2017, so the last big tax change, they thought about potentially getting rid of Section 1031 to raise revenue via reconciliation, and it didn't happen. But that's always going to be something that people question. I mean, all these different 10 plans, I mean, they're all individual plans. It's not like all 10 of them necessarily will all go through. It's probably one or two. And that's why it's important to really try to keep up to make sure that your plan is equipped to handle these changes.
Yeah, and that's why we recommend you look at your estate plan every year. You need to pick it up and look at it, make sure it's what you want, and then meet with a lawyer at least every 3 years. We're going to be offering you guys the opportunity to meet with us in after February 16th at no charge, okay, to go over your estate plan to make sure you guys are squared away. So the eliminating of the 1031 exchanges is a really big deal. And, you know, I was talking to Connor, I was talking to a person in the real estate industry on a national level, and they're in a big company, and they said they were talking to their lobbyist who was lobbying a member of Congress when they were talking about taking the 1031 exchange away. And the congressman thought he was talking about 1031, like it's 1031 in the morning. Like so just because they're lawmakers, they don't know the tax code. Okay. Increase the child and dependent care credits from $2,000 to $4,000 for one child or $8,000 for two or more children. Basically it's free money. I mean, you know, if the goal is to get the 10 million Americans who are in poverty out of poverty, giving them money is probably the quickest way to do it. And that's part of Biden's plan. $15,000 tax credit for first-time home buyers. That's kind of cool. Green energy. This is really big, but what I want to focus on here for those of you who have bought oil and gas investments, those are very tax advantaged. That's why the United States is now the #1 oil producer in the world. Again, I'm not going to talk politics. You can say, oh, that's terrible. We're pumping carbon out of the earth and putting it in the sky and poisoning our atmosphere and oceans. But something you need to know is the law will likely change on this. And if they do eliminate the federal income tax deductions for oil and gas, you need to pay attention to that because your taxes are going to go up, right? If you're going to lose those deductions. Now, whether you'll lose them from prior investments, I have no idea. But folks, you need to pay attention to this stuff because, you know, the times are a-changing. Finally, repeal of the TRJICA, the 2017 Tax Cuts and Jobs Act. This brought a 21% federal flat income tax for 2018 and beyond. It was 35% before then. Biden wants to raise it to 28. I think he's probably going to get it. But they are also talking about a minimum tax of 15% on corporations with at least 100 million in annual income that pay little or no federal tax under the regular rules. You can think of this as like an alternative minimum tax for corporations, which, Connor, human beings are subject to alternative minimum tax. And it's kind of interesting that corporations aren't. But again, it just seems a little inconsistent that corporations have a bit of a tax break that human beings who are filing individually don't. What do you think about this? Connor, what are your thoughts on this minimum tax?
I think that it's the answer to what a lot of people have been complaining about, because you see those companies that have so many deductions that they don't have to pay any income tax. You just have people potentially paying on their shares when they sell or when they get dividends. I mean, a lot of these different laws, if you want to look at the actual mechanism of how they could potentially pass, it's because the House is controlled by one party and the Senate is now 50-50 split. Mm-hmm. And then you have the presidency by the same party. And while the filibuster affects creating certain laws, they don't need to overcome a filibuster in reconciliation. If the government wants to change the tax code, as long as it's revenue neutral, they do not have to change, or excuse me, they don't have to overcome the filibuster. So that's why it's possible for the tax laws to be changed, because if they raise more money via a corporate tax hike, they just have to spend the money to make it revenue neutral. And that's reconciliation. That's how the 2017 Tax Cuts and Job Act was passed.
So that's why we're saying high probability of a tax increase. I firmly believe in taking politicians at their word. You can't say, oh, well, this person says this thing, but they're not really going to do it. That doesn't happen in the real world. people do what they say they're going to do. And I think history bears that out. So, I mean, long history bears that out, right? So what are the changes in the tax rates? This is a bit of a recap. When is this going to happen? And so the income tax rates going to 39.6%, gift tax increase of 40 to 45, capital gains tax up, death tax going from 40 to 45%. So you would think, well, that's not bad, 40 to 45%. That's just an extra 5%, no big deal, but just wait. What about death taxes? Death taxes, how I read this for Californians, this could be over 80% for Californians. And let me show you how we get there. So this is from the Tax Foundation. And I have my next slide is from the Brookings Institution. So I'm kind of on balance on both camps here. But here's what's going on is the example here, and it makes the math easy. The example here is a $100 million estate. Now you may think, Jim, $100 million estate, what are you talking about? This is crazy. It just makes the numbers easier, okay? So if the original asset is $100,000 here, or is $100, your capital gains taxes are realized at death. So this is a really, really big deal. Now, if your capital gains are realized at death, what I mean is if you have something that's worth $100 that has a $1 cost basis or a zero cost basis, you have to realize those gains. And in California, the scary thing in California here is that you're ending up with a 13.3% effectively capital gains tax rate because California doesn't have capital gains, it's income tax. I would assume that if this bill passes, California is going to say, wow, what a great system. Now we get to well, I'm just moving a mouse. I'm clicking something here. Now we get to go ahead and tax people's estates and we get to lump on our other 13%. So this is kind of a backdoor death tax for California. And I would be really concerned about this if I were a taxpayer with low basis assets. Now, what's this going to do to the, oh shoot, I'm sorry, I'm having a little technical issue here. Okay. So what's going to happen when a person passes away and they have a $100,000 estate with maybe a $50,000 capital gain? Are they going to have to pay that capital? Are they going to have to realize that capital gain when they die and throw that $50,000 profit onto a death tax return? I don't know how far the government would drill down, or if they would say, okay, the first $3.5 million, you're going to get an adjusted cost basis on it, because it does not seem fair to tax somebody who's inheriting $20,000 asset and they have to pay tax on it. That just seems a little crazy to me. Now, if you go down the second paragraph, it says value of remaining assets. So what we've done is we've taken this $100, you pay 43.4%, but it might be 56%, right? Because California's 13. Now you've got $56 left over. You get your Biden $3.5 million exemption. Whatever's left over is 45%, okay? What is taxed at 45%. So your effective tax rate 67% plus California's 13.3. That's how I get to 80. Okay. Now, if you're like, wow, he went through that really fast, I really don't understand what Jim said. That's okay. We're on it. This is why you need to reach out to us. We're not going to charge you for the initial consult after February 16th. And we can talk to you guys about this and meet with you one-on-one and make sure that your estate plan is set up in a way that maximizes the wealth transfer for your family, because that's really the issue. We want to make sure that we get you through, we go from your estate to your kids or your loved ones and minimize the tax. Now, the Biden tax plan, this is an infographic from the Brookings Institution. This is what's happening. When we talk about a tax raise on the ultra rich, it's not, I don't see this going up a whole lot, quite frankly, Connor. When I look at this, I mean, the absolute numbers are big, but I mean, I wouldn't get too concerned about it in terms of paying more income tax. There are things that we can do to mitigate that. There are some planning techniques, but I would say don't panic, but just plan, right? Planning is a better alternative than panicking. Okay, so what happens is this money comes in by increasing the corporate tax from 21 to 28%, and they're getting another $1 trillion over 10 years by lifting the Social Security cap. There's a certain logic to that. I'm not agreeing with it, but I can see the logic. And taxing capital gains as ordinary income if your gain is more than $1 million. But remember, if you realize capital gains at death, where the government forces you to pay a tax. So they're treating at death, they're treating it, the capital gains tax, more like a death tax. By the way, this is Canada's system, okay? And Canada's had this for 25 years. This has been around. There is precedent for this. Any thoughts on this, Connor?
I mean, like I said, or like this stuff has been tried. This stuff is on a long wish list. So some of it may not happen, but some of it probably will. And it's important to pay attention, because if you don't pay attention, you're going to be left behind.
So when can we expect these changes? I think they're going to be effective 2022. Why? Because many of these involve payroll taxes, corporate taxes, and other taxes that make it difficult for companies and corporations. You know, if this is passed in September, also we're in the middle of a pandemic still. If this is passed in September, all these companies are going to have to go back and recalculate payroll. It's a real pain in the neck. Many tax increases are effective. By the way, they're effective the following year. As Connor said, it only needs 50 votes in the Senate. We've got Kamala Harris who can cast the deciding vote. Now, there are well-established strategies that, and I put wealthy in air quotes, that people over 3.5 million in wealth, and that will be the new definition of wealthy. There are many strategies that people can use to reduce income taxes, capital gains, gift, and taxes related to transfer of wealth. And yes, it is true, rich people do pay less taxes because they do three things. Number one, they hire the best advisors, they take their advice, and they have the capital that they can deploy in a strategic manner. So you may not view yourself as wealthy, but I want you to think about everything that you own. Everything is held in a joint account with Uncle Sam, right? And Uncle Sam's going to get his cut of everything. It's just the way it is. So who should do what and when? If you have more than 2 million, and that's a low number, I got to tell you. Now, if you own a home in the Bay Area, you're probably halfway there. And if you have any kind of retirement savings, that's probably getting you to 2 million. So I would say these are like normal middle-class people who are going to be affected by this. But if you have more than 2 million in net worth, that includes your savings, investments, home rentals, commercial industrial properties, annuities, I really recommend that you seek advice in 2021, because if you wait too long, it may be too late. Okay, so we're really encouraging people to come in this year before the tax law becomes effective. Connor, do you want to talk about a spousal lifetime access trust?
Yeah, so spousal lifetime access trust, this is a response to the potential lowering of the estate tax. I mean, even without whatever you want to call it, the shifting the government, that current 11.7, the doubling of the estate tax, is set to expire in 2026. But a lot of our clients believe that it might go away sooner. Now, the IRS has said that if somebody has given away more assets in their life than what the exemption is when they die, or when the laws change, when the threshold's lowered from whatever it is now, they're not going to claw back. So what I mean by that is, like, if someone gives away $6 million this year, and next year they lower the exemption from 11.7 to 4 million, they're not going to claw back the 2 million to make them pay tax on the 2 million that they already gave away. That person, the donor who gave away the assets, they're going to be off the hook. And so some of our clients, they're gifting away now more than whatever they think that exemption is going down to. So, we have people who believe it's going to get cut in half to 5.5 million. So they're gifting away somewhere between 5.5 million and 11.7 million. That's the maximum this year, without paying any gift tax, to their spouse or to their children. And they don't do it just like in an outright gift. They use something like a spousal lifetime access trust. So with this, we have one spouse who makes that gift of whatever it is, somewhere up to 11.7 million, to a trust. And the donor spouse, the one who makes the gift, they're out of the trust. They're out of the assets. The other spouse, the donee, they get access to those assets. And eventually their descendants will get access to those assets. But Go ahead, Jim.
Yeah. So basically the husband puts a chunk of money into a bucket for the wife, right? Or the spouse. And the spouse gets to use that money, but it's outside of the estate. So it's still there for one of the spouses, but it's outside of the estate. And sometimes people do two. You have to be really careful with that. I think we're going to see a lot more of these with the passage of Prop 19. So grantor retained annuity trust, all this is you put money into a bucket and you take it out over a period of time, and it shifts the growth to the next generation. So if you put $500,000 into a 5-year grantor retained annuity trust, your payments of interest back to you, which you don't pay tax on, they total 525, but during the term, the return is 625. So the assets go to 625. So $100,000 effectively transfers to the children tax-free. I think you can see how wealthy people would use this strategy all the time, and they do. Sale to a grantor trust, this is instead of getting the money back, you sell the asset to a grantor trust and you take back a note. So if you sell an asset for $500,000 to a grantor trust, there's no capital gains that you realize, and the payments on the note total $525,000 over 5 years, but the property has grown to $625,000, so a net of $100,000 goes to the children, kind of the same result. There's going to be no test on this. We're just introducing you to a little bit more advanced planning that I think is going to be brought down to not so wealthy people. Gifting trust to children, you can place assets in a trust while the exemption is 11.7 million. You know, if you're wealthier, but you know, even if you have a $5 million estate, you might go, Jim, I'm really worried, and I may want to put, you know, 2 million into a spousal lifetime access trust and maybe have the future growth be out of my estate because I'm really worried about this $3.5 million exemption. Estate taxes, death taxes are due 9 months after death. Folks, that is not much time, because a lot of people, it takes them 3 months just to get to the lawyer's office. And then the lawyers are like, great, you know, now we only have 6 months. And, you know, there's a lot of work to be done. So on a gifting trust to the children, the income can be distributed to the children or not. The principal is free of gift and estate tax. Generally, real estate transferred to children pre-February 16 will not be reassessed. There are some limitations, but generally it's not reassessed. And so if you have real estate and you want to take advantage of the parent to child transfer, we'll talk about that in a little bit. You need to get moving on that ASAP. So do you remember the TV show? This is probably before your time, Connor. What's this TV show called? It's called Dynasty. So there's another planning technique with the exemption lowered to 3.5 or 6 million, whatever it's going to be. When your children inherit, when your wealthier children inherit, or maybe they don't have any money and you've got a lot, it's going to be thrown on the pile, and it's going to be more death tax when they pass away. So keeping it out of their estate sometimes makes sense. And basically the children get the rights to the trust assets during their life, and then the leftovers, right, whatever's left goes to the grandkids, death tax free. This is called a generation skipping trust. It's also called a dynasty trust. I really hate the term generation skipping trust because clients say, well, I love my kids. I don't want to skip them. You're not skipping them. It just deals with the generation skipping transfer tax. So what about Prop 19? Have we been busy with Prop 19, Connor?
Yeah, it's a really interesting time that you guys join us, because we might be the busiest that we've ever been because of the property tax laws changing significantly and in a really short amount of time. They really gave us, what, 3 months?
Yeah. I would say what is Prop 19? The parent-to-child transfers are generally eliminated, okay? Inherited property generally, as a general rule, will be reassessed. Inherited property is reassessed, except when it's a parent-to-child transfer. That goes away February 16th. Now, it's a home of any value plus $1 million assessed value per parent. Okay,
that's the current rule.
That's the current way. That's expiring February. The law is effective February 16th, although at the Board of Equalization meeting, the attorney for the Board of Equalization said, whoever wrote this law didn't read the California statutes that say if the law is effective on a date that is a holiday, which February 15th, nominally this is effective February 15th. If it's a holiday, it doesn't become effective till the close of business the following day. So whoever wrote this just didn't do a good job in terms of writing the initiative. They kind of picked the wrong date. So here's how Prop 13 works. In the 1970s, you buy a home in Cupertino for $50,000. This is actually a home that was recently listed for $2 million. It's now worth $2 million. I don't know if it's sold or not. If this is your house, it would be a crazy coincidence. The property is assessed at $120,000. Okay. So many people who live in the Bay Area, they have a home that's worth a lot that they bought a long time ago, and they're protected by Prop 13. And so these taxes are $1,500 a year. Now, our current property tax structure, here's what Prop 13 is. Property is assessed at 1% of market value when there's a change in ownership. Change in ownership includes a sale, gift, and death. This is very important. A lot of people don't think that death is a change in ownership. Once there is a change in ownership, so you buy that property in the 70s, the property tax increased by the California Consumer Price Index, right? But it's capped at 2%. And so what happens is if your property taxes are capped at 2%, they're going up really slow. But if your property is going up at 4, 6, or 8% or 10% a year, that's how we get that big delta. That's how people can live in a $2 million home and only have $120,000 assessed value. And so long-term owners of California real estate have typically have lower tax bills than newer owners. And everyone is protected by Prop 13. This is very important to understand, Connor. When you buy your house, and in the 2020s, you are protected by Prop 13 because that means your taxes can only go up 2%. So it's not just the people that bought in the 70s. And so in the 1980s, there was a law that was passed that, people said, wow, this Prop 13, man, this is good stuff. But when you die, you lose it. And when your kids inherit it, you lose it. And so what happened is Prop 58 was passed. That was a ballot initiative. And that let the kids keep the parents' Prop 13 taxes when there's a change in ownership. So the kids, you kind of mash up Prop 13 and 58. So that change in ownership, that's a death or a sale or a gift, when that goes from parent to child, the child takes the parents' Prop 13 taxes. It's just a great, great benefit. Connor and I did a webinar. It's now our YouTube video. This is on our YouTube channel. It's now has over 15,000 views. We got another video with 5,000 views. That was, what was that, Mustache November? What was
it was also when I could get a haircut. So.
Yeah. I still have my long hair. I still have COVID hair. So again, subscribe to our YouTube page. That will keep you informed. And, this is not a sales pitch. Honestly, I would subscribe to this YouTube page so it appears in your feed. And so you see it, because we do these webinars many times more than once a week. Okay. So we're very current on all the things that are happening in California for you guys. So let me give you an example of what happens before Prop 13. If the parents, this is about porting over your Prop 13 exemption, and this is going to be a really big deal going forward. But under current law, if you bought this home in Cupertino and you said, you know what, Cupertino is great, but I want to move to Piedmont because my kids live in Oakland and I want to be closer to them. And, I just want to be on the East Bay. So you sell Cupertino, you buy Piedmont for $2.3 million. Your property taxes are going to go to $27,000. Now, I don't care how much money you have. Paying $27,000 on your home is a lot of money because only $10,000 is deductible. That other $17,000 isn't deductible because of the SALT limitations, the state and local tax, at least currently. So this is it's kind of expensive tax to pay because you have to pay this in after-tax dollars. It's not like, paying tax on a rental. Alameda is one of the 10 counties. Okay, so currently you can move from one county to another. Alameda is one of the 10 counties where you can move your tax base. But if the market value is greater than the Cupertino home, you're going to get reassessed. And that's a really big bummer. If the property were $2 million, you wouldn't get reassessed. But because it's 2.3, you do. And by the way, you can't try and sell it for a less amount because the property is reassessed at its fair market value, not at what the property trades for. So the assessor is free to say, you know what, you guys had an agreement that house would be sold for $2 million, but we think it's worth $2.3 million, so we're going to reassess you. Now, after Prop 19, this is one great benefit of Prop 19. The client sells the home in Cupertino, moves to Piedmont. The property taxes only go from $1,500 to $5,250. Prop 19 is a huge benefit. So I know there's people are throwing a lot of shade. They're criticizing Prop 19. They're saying it's horrible. Well, it's horrible for the kids. It's actually really good for homeowners because now you can sell your property and you can take your property tax base anywhere in California, anywhere. There's no restriction. And you can even buy a home of greater value. And what you do is you add that $300,000 delta to your tax bill. So this is a great, great benefit. And we can stick a fork in it. Parent to child reassessment exclusion is done. It is gone effective February 16th, unless it's a family home. Now, here's the wrinkle on the family home is at the assessors meeting on Thursday, or the Board of Equalization meeting on Thursday, they were asked, so tell us more about this family home exception. Here's the position that the Board of Equalization is currently taking. What the Board of Equalization is saying is if it is the family home, which is defined as the parent, the easiest way to prove this is if you check your homeowner's exemption on your property that you're living in. The parent is living there when the parent dies. A child inherits the property. So if you have 3 kids, only one needs to move in. That child must claim the homeowner's exemption within 12 months. But if the child ever stops using the residence as the primary residence, ever, if it stops using that home as the family home, and an example would be moving out and renting it, if that happens, the property is reassessed, okay? So one of the Board of Equalization members, I believe from the northern half of the state, kind of a cowboy guy, he was funny. He goes, you mean to tell me we're going to have to drive by and we're going to have to start knocking on doors and we're going to have to, like, really, Connor, I thought this was almost comical. Like the assessor, is this going to be self-reporting where you say, oh yeah, I moved out, it's a rental? I mean, what do you think about this, Connor? I think that as a lawyer, I view this as just completely unworkable. Like, I don't think the assessor is going to get in their car and start driving around and checking license plates. And what do you think?
The assessor did not write this law, so it was written by somebody else who probably didn't think too much about how it would be enforced. That said, if the person who occupies the house moves out and they, say send my tax bill somewhere else, and they take off the homeowner's exemption on the property tax, maybe that will trigger them to think that the kid moved out. I'm not entirely sure. But I also think it's important to note that $1 million limit on top of the assessed value.
That's true. So what that means is if your home is worth, if your home is like in this case, the Cupertino property, the kid would get reassessed. The assessed value would go to, for the kid's tax bill would go up, I don't know, another 10,000, something like that. So it's not a freebie. It's not an unrestricted freebie.
If you look at your property tax bill and like, let's say your assessed value is 400,000, even if your child moves in or one of your kids moves in, you only get $1 million on top of that assessed value. So if the house is worth $2 million, anything above 1.4, they're going to reassess, even if the kid moves in. There's that limit that they put on there. And that limit works well in certain parts of the state, but it doesn't work so well in the Bay Area because so many people have seen over $1 million in gain on their house.
We've met with, I think now probably almost 400 people firm-wide about Prop 19 matters. And I would say probably 2/3 of the people I meet with, people have a property that grandma or grandpa bought or their parents bought in San Francisco that has an assessed value of 100,000 that's worth $1.5 million. I mean, that's basically 2/3 of the people that we're talking to. And that's a really big, that's a really big motivator to save that. So what can you do? We're doing a lot of planning for clients, either outright gifts or Prop 13 trusts. It's an irrevocable trust structure. This is not a living trust. It allows you to pass Prop 13 taxes to your kids now. It preserves Prop 13 for your kids' lifetime. You got to do this before February 16th. The parent's the grantor, the children are the beneficiaries, and there is a change in ownership. Whether there's this adjusted cost basis and this tax benefit is case specific. But Connor, as you and I know, there's no one size fits all. Every one of these cases, I mean, estate planning, we say, oh yeah, every estate plan is unique, but come on. I mean, a lot of them are similar, but these are really totally different. All right. So you want to talk about acquiring property in an LLC?
Yeah. So now, at least moving forward, if you want to avoid reassessment, you have to acquire your properties inside an LLC. And when I mean avoid reassessment, I'm talking about when you pass away. Because property acquired, and when I say acquired, it's never going to be in your name. So if you're looking to go buy a rental, you go buy your rental, and instead of deeding it to you and your spouse or just you, it immediately is purchased and put into an LLC. Now, the rule is, as long as when that property is transferred, it goes to multiple beneficiaries and no beneficiary's stake in the company inside the LLC is over 50%, they don't consider that a change in ownership.
So
So
yeah. Do you want to talk about the Michael Dell case?
yeah, that's exactly it. The Michael Dell case, the guy who was high up at Dell Computer, probably founded it. He bought a hotel, and that's how he structured the sale. The property he bought, less like about 48% was transferred to him, about 48% to his wife, and then the other remaining percentage was purchased by some group. But no one here had over 50%, even though it's him and his wife. They treat him as separate people. There was no change in ownership because nobody acquired over 50%. So if you transfer your LLC upon death to your 2 kids or your 3 kids, you're good to go. Or if you have one child, maybe the kid and your grandkids, or kid and their spouse. You can avoid reassessment this way, but it has to be for properties purchased by an LLC. What happens if you gift to an LLC?
Well, if you gift to an LLC, then when more than 50% of the LLC units transfer, the property is entirely reassessed. And it's very important. If you have multiple people and, if Connor and I own a piece of property and I sell my half the property gets reassessed. But so it's not binary. It's a scale. It's percentages. It's slivers. It's halves and quarters and thirds. But reassessment when it comes to entities is binary. What I mean by that is it's either reassessed or it's not. There's no in between. So if 51% transfers, boom, the whole property is reassessed. So you really do need an expert lawyer involved with this. And I will tell you, this area of practice is a microscopically small area. It is about to explode like 10,000x. Because once the parent to child reassessment exclusion is gone and you want to get your commercial, your industrial, your rental properties, your family wealth to the next generation, it's going to be a lot harder without the parent to child reassessment exclusion. And the need for an expert is going to be that much more, unless you're okay with the property getting reassessed or unless you're okay with paying the death taxes. So again, this is part of the mantra of, and I've been saying for years, by the way, that the legislature wants to get rid of Prop 13. They want to throttle back Prop 13 because it's really hard to raise revenue in California. I mean, that's why our income tax is so high. That's one reason the fees are so high. You should see some of these tax bills that we look at. The 1% tax is very low, but then you see the supplemental stuff. I've seen a lot of tax bills where the taxes are $700 a year, but the parcel taxes are $4,000. Right. So it's really constrains government when government is not free to, when they're constrained by Prop 13. I love Prop 13. I benefit from Prop 13. I'm not complaining about it. I'm just telling you that California doesn't like it. So the rules on your IRA have changed. So in 2019, Congress eliminated the stretch IRA. All that means is when you die, it used to be your kids could stretch out those payments for their whole life. If a kid was 50, they could take the payments out over 35 years. All was good. If your kids were disciplined, which only 13% of kids are disciplined because 87% of IRAs are immediately liquidated. Now your RMDs start at 72. And when you want to talk about what happens when they inherit IRAs and retirement accounts, Connor, what the new rule is?
Yeah, IRAs, 401ks, generally speaking, your kid has 10 years to pull out the money and 10 years to pay tax. So they got to figure it out. I mean, either way, it's not going to be great because if you leave 500,000 or $1 million to one of your kids, they're going to pull out whatever, 50,000, 100,000 a year minimum, and they're going to pay tax on it. So it's going to be a big tax hit, but it's better than taking it out all year one and having $1 million in income, or in year 10 and having 1.5 million in income. So it's important that your kids are on the same page with you. I mean, people ask all the time, how do we avoid this? And it seems to be a lot simpler approach to have a Roth IRA if possible, because these Roth IRAs, distributions are tax free. If you die with a Roth, your child still has to pull out the money within 10 years, but they can just leave the money in trust, or in the inherited Roth until year 10, because who cares if they pull out 1.5 million if it's all tax free, right? So if you have a Roth, that's great. If you're still contribute to that Roth for that purpose. And if you don't have a Roth, definitely consider a Roth conversion. It doesn't make sense for everybody, but it makes sense for a lot of people.
So Roth conversion, people say, well, why would I pay tax now when I can just delay paying tax? This is part of an overall, certainly if you're in your 60s, you need to take a look at this. If you're late 50s, 60s, maybe retiring, we can connect you with a qualified financial advisor who can go through all of this. But many of our clients, in order, and this kind of goes back to the point at the very beginning of this, is the idea is to pay the least tax possible, pay the tax that you're lawfully required to pay, but figure out a way to minimize that so that maximizes wealth for you, maximizes wealth for your family, and creating a lasting legacy. Many of the people we meet with, some of them are multi-generational wealth, but I would say the vast majority of people we meet with do not have much inherited wealth. They kind of made it themselves. And they really want to preserve that for the next generation, because I think it's harder now. Connor, I mean, I'll say this straight up. It is harder to live in California now than it was when I was your age. It's harder. A lot of stuff is harder. Things are more expensive. Real estate's more expensive. It's crazy. It's not easy. If you want to live near your grandkids, right? Because if you're worried about your kids, you're going to have to move to Texas because they can't afford to live in the Bay Area. It makes sense to do some planning. So, all right. And then there's the IRA trust. An IRA trust, you want to explain what that is, Connor?
Yeah, some of our clients, they have these big IRAs. The IRA is the biggest asset they have, maybe even more valuable than their house. And they don't want to necessarily leave that money just outright. They'd rather try to use a trust to give that same asset protection, or potentially maybe let another child, like, the sister who's better at managing money, help make those distributions. And it really makes sense when you have these Roth IRAs, these big Roth IRAs, because at year 10, you can just leave that money in trust and get that same asset protection. You can maybe even turn it into a generation skipping or dynasty trust, as Jim says, if your kids have plenty of money. But it's all case by case. Like a trust, people have trust, like the revocable trust to avoid probate, prepare for incapacity. These IRA trusts, they're for certain clients who have the right setup. And the only way to find out is, if you do an individual appointment.
Yeah. So free amendments, I love free stuff. Just to clarify, those are gone. We do a lot of education. We do free consults. And so those
And I do want to
days,
say, let me tack on, Jim. I mean,
yeah.
I do agree with you. It would be hard to find an attorney who does free amendments. I mean, that seems like a relic of another time at this point, because people like to charge.
Yeah. Well, I mean, we got to pay staff. We got bills to pay. And so what we have is our time. And that's about it. So to kind of recap, the idea is to protect your assets from creditors, predators, and divorce, inherited assets, your legacy, trust protector. Think you should consider, start thinking about a trust protector, whether you have the right successor trustee, and advanced planning strategies. So here's what we're doing. If you watch a video right now on Prop 19 and you are not a Howard Neal client, then we are charging $1,000 for that consult. Now you may think that is crazy. You're charging $1,000 for a meeting, but let me tell you something, folks. Very few lawyers even have capacity to meet with you to do anything, because all of their clients are melting down their phone by calling about Prop 19. People are panicked. I was on the phone with a woman a couple of days ago. She was crying. I was on Zoom and she was crying. And I felt so bad that, here's this poor lady who is really petrified. So, what we're doing is, for those of you who want to meet with us about Prop 19, we're going to reduce that to $500 for Howard Neal's clients. And you can meet with Howard for these Prop 19 matters, or with one of us. We have very few time slots available. And I would highly encourage you to, when you go online and book an appointment, and I'll show you how to do that in the next slide, go ahead and make sure you say in the email or in the notes that you're a Howard Neal client. We'll give you priority, okay? Because we want to help Howard's clients. And both Howard and Connor will be meeting with you guys on those, or another attorney as available. But we have very limited availability to meet with you. I just want you guys to understand that. We're just frankly running out of capacity. So for matters other than Prop 13 or Prop 19, we're now accepting appointments for free consult, but that'll be scheduled after February 16th. So that'll give you two things. One, it'll give you the opportunity to get your stuff together. It'll give us time to get your file from storage, because your original documents are in storage. And then we can meet after February 16th. So we really have a log jam right now. All of our staff are working literally around the clock every day to help all the people who are coming in to take advantage of this sort of 11th hour planning opportunity, the twilight period of Prop 13, the parent to child reassessment exclusion. And if we do perform additional services, there are additional fees, but that initial consult to go over your estate plan is no charge. And you can call the phone number there, 866-988-3956 or 530-269-1515 if you're out of the country, to set up a Zoom or phone consult. Or so calling, you can also go online, and where you see here, this is the front page of our website. You can book a consultation, and we're here to welcome you guys, the clients of Howard Neal. And then I would also recommend, and you may want to do this right now, okay, if you can, or as we do the Q&A as we wrap up, go to our website, CunninghamLegal.com. Please register for any webinar. If you register for a webinar, we will capture your email. You will then be on our email list. So you just register for a webinar, pick one, and there's just this is the next one we have. I just pulled this slide off of our website this morning. But you pick any one. You can attend or not attend, but at least you're in our email database, and so that you'll stay informed. We do send out weekly emails to keep you informed. And the idea is we want to help you. We want to add value wherever we can. And we feel that using this technology, using the platform of YouTube is the best way to do it for our firm. And so again, you can make an appointment. You can call those numbers, go online to Cunningham Legal. The Prop 19 consult is a paid consult. And let me tell you about Prop 19. If your kids, and we'll open it up for questions as well. So as we're finishing up here, you can go ahead and write your question in the Q&A. Connor, I think we should talk a little bit about who should not be doing Prop 19 planning. If you are going to sell all your property when you pass away, first of all, if you don't have kids, there's no reason, there's no urgency on Prop 19 planning. If you're going to sell all your assets, all your real estate when you pass away or when one spouse dies, is there a need for Prop 19 planning?
No, because there's no property tax to play.
Right. If your property is assessed at $1 million and it's worth $1 million too, I'm not getting particularly excited about that.
Yeah.
Here's what I do get really worried about with clients and intellectually excited about. If you have a trophy property, a beachfront property, a lakefront property, a vacation home, something that maybe your parents bought for $100,000 that you inherited, and now you want to leave it to your kids and it's worth $5 million. Okay. That's a property where you really do need to look at this. I'm less intellectually excited about the income producing properties. And the reason is twofold. Number one, you have rents to cover the property taxes. And number two, those rents are deductible. So it's less of a hit on the family. But Connor and I, we've met with so many people that have the trophy family home. Not only could the family not afford to buy that home again, they can't even afford to pay the property taxes if it's reassessed at 1.2%. So any thoughts on Prop 19, and then we'll start answering questions here.
Yeah, I mean, we're getting so close to that deadline, and we wish we could just help everybody, but we can really only help so many people at this point. I think the best candidates, if there are best candidates for Prop 19 planning, are going to be somebody who just got a step up, maybe because a spouse died, right? They have a low property tax. That might be the real only scenario where it's worth it to do Prop 19 planning at this point.
Okay, we got some questions here. Camille asks, I have my deed in my trust fund. How will taxes affect this? The goal is to ensure that my home does not go into probate. Camille, if your property is in fact in your trust, it does not go through probate. However, property taxes might be an issue, so you would want to definitely check in with somebody. But you also asked a follow-up question. Can you discuss assets in your trust, such as a home donated to charity? So Camille, if you're going to leave your home to a charity, then there's no need to do Prop 19 planning because the charity is going to get reassessed anyway. But some people do leave a home to charity. And what some charities will do is they will say, you know what, you can leave your home to us. And if you irrevocably commit to leaving your home to us today, you will get a tax benefit. You'll pay less income tax. So if your plan is to give your home to charity anyway, there might be a way to do it in a tax efficient way where we look at what your income is, and you may want to give a third of the property this year and a third of the property in 5 years and a third of the property in 10 years. You may want to spread it out. It depends on what your income is rather than everything all at once, because you can only carry forward that charitable deduction for 5 years. So that's a math function, and that's one of the things we help clients with. Suresh says, can you send us the slides from this presentation? If you put your email in the chat, I will send that to you, Suresh. What is your hourly rate? Anonymous asks. Connor, what's your hourly rate?
My hourly rate is $450 an hour.
Mine is currently 600, but we do a lot of our estate planning is done on a flat fee basis. And so I don't do a whole lot of hourly work. Connor, do you? I don't think you do either, do you?
Not for estate planning, but for administration, other matters like that, potentially.
Lorenzo says, I'm a bit confused. Well, welcome to the crowd. I have an income property worth $2 million. I was expecting to pass to my 2 sons after my death. Should I do LLC planning with you before February 16th? Lorenzo, you should call or email. And by the way, don't give up. We're getting, folks, I'm not kidding, like 100 or 200 inquiries a day. Okay. We're only 30 people in our entire firm. So it's very important that you let us know that you're a Howard Neal client, and we will give you priority. Okay. So it's very important that you do that. But Lorenzo, I would highly recommend that you reach out to us and look at that, because a $2 million income property that you want to leave your kids, it's very important that you consider using the Prop 19 parent to child, or the Prop 58 parent to child reassessment exclusion. But I will tell you this. If you're going to Tahoe, there are 2 ways to go. You can take Highway 80 or you can take Highway 50. All things being equal, most people want to take Highway 80. They can stop at Aikida's, they can get a pie, but it's a lot easier to get to Tahoe on Highway 80 because it's a multiple lane interstate. Highway 50 is 2 lanes and you got to stop at traffic lights in Placerville, and a rock might fall on the road and now you're delayed for 3 days. There is a different way to do this. So you can do the parent to child transfer. That is the Highway 80 way. It's the easy way. It's like passing a football in a football game, 60-yard pass and you run for a touchdown. Using LLCs and entities, there is a way, and rich people do this, there is a way to do a parent to child transfer, but it takes years and it's more expensive and it's a hassle, and it's the Highway 50 way of getting the property to the kids. But it is not as convenient, and it's the running game of football. It's, every play you get 3 yards and it takes you forever to get to the end zone, but you'll get there. It's just a different way to go. So Stephen asks, I have an inherited property that has a tax basis of 170, is now valued at 400 under Prop 19. What happens when my daughter inherits? The property's reassessed. Your taxes will probably double, maybe a little bit more than double.
Okay, go ahead.
If what, Connor?
Was that a house they live in, or a house they don't live in?
Didn't say.
If they live there, the daughter could move in potentially. But if it's not a house you live in, there's going to be reassessment.
Yeah, and if you don't, again, if you're relying on this new parent to child reassessment exclusion, guess what? You may not be living in that property when you die, because you might be living in assisted living. And now I don't know if you live in assisted living, if you can still claim it your home. We just don't know, right? Because the rules haven't yet been written. Andy asks, is there a way to put an UTMA account into a trust so our soon to be 18-year-old will have some limits on spending the funds? Andy, the only way to do it is if the 18-year-old is on board with it. Connor, do you know another way? I mean, I've seen judges just say no. I've seen that in court. They're like, sorry, the kid gets it. So
yeah.
Deborah asks, when I sign up for a consultation online, is this the initial free consultation? Go ahead and specify. And I'm sorry, this is seems a little bit haphazard or disorganized, but we're getting overwhelmed by Prop 19 inquiries. Okay, I'm just being brutally honest with you. We did not expect this kind of a response. If you put in there that you would like a free consultation about your estate plan and you're a Howard Neal client, we'll put you in the queue. It may take a while for us to get back to you, okay? But we will get back to you. Richard asks, what is the difference between a trust protector and a fiduciary? A fiduciary is typically a trustee. A trust protector is somebody who has power over the trust, but is not the trustee. A trust protector can serve in a fiduciary capacity or a non-fiduciary capacity. And Lorenzo says, by the way, your office message speaks of office closing in December and New Year's. Thank you very much. We'll get on that. Thank you. So Michael says phone number 510-339-0233 is listed in the letter we received. Should we use that to contact? You can use either. They all ring in the same location. So we have like every other business now, we've got VoIP phones, and they are answered remotely by our staff, who pretty much is at home right now. Most of them are working from home most of the time. Andy asks, we currently have a disclaimer trust. Is it better to have an AB trust structure to assure that the surviving spouse will not change beneficiaries if he or she remarries and inherits stepkids? You know, I would say, Andy, we should talk about that. You could use an AB trust structure. You could also use something called an AC trust structure. And the C, of course, is the Q-tip trust. Connor, do you want to say what a Q-tip trust is for?
Yeah, it's oftentimes to lock down assets, just like the way you're talking about. People do have that fear, and it's a legitimate fear. The B trust, though, when you talk about AB trust, whatever goes in B, your kids won't get a step up again when the surviving spouse dies. So that C trust, they probably will. So that's the reason why it's definitely worth looking into a Q-tip trust. But I mean, still, a lot of people are idealistic when they do planning. You have to be realistic. You have to make sure that you're ready to live with your kids, really, or limitations on your assets if your spouse passes away. So do an appointment and really try to think, could you live like that?
Okay. And then I'm just answering some questions here real time. Michael asks, let's see. Oh, Michael says, please send me a copy of today's presentation. This will be posted online on our YouTube, so it'll be available. Again, Michael, I'd recommend that you subscribe to our YouTube page. And then I think what you're asking, though, is to get a slide deck. So we'll go ahead and send that to you. Mary asks, please send me the slides as well. Geez, I don't know. I'm not quite sure how I'm going to manage this, but I will do my best to get you the slide deck. Let's see. Please send the screens from the presentation.
I see. Can I answer this one really quick?
Yeah,
by
sure.
Arlene? So what if I have two properties, both worth less than $1 million currently, and I want them to go to my son? Do I need to confer with you regarding Proposition 19? You can try and call us and schedule, but that's the issue right now, is we're really booked because we're working around that February 16th deadline. And we can only take on so many clients because we have to really help the clients we're working with. And I know this is kind of a lame way to respond, but this is kind of an unforeseeable busyness that we've had. Yeah. Now you could call in, and since you're a Neal client, I'd be happy to talk with you for 15 minutes, because the question you're asking here, I can't totally answer. I can't promise you that, we can take you on and do all the deeding and maybe create a trust before February 16th. But as long as you identify yourself as someone who came to the presentation, spoke to me on the presentation, I'd be happy to give you a 15-minute phone call.
Do you have time on Monday to do that, Connor, or not?
If not Monday, then Tuesday. Yeah, okay. I believe Monday's pretty busy for me, honestly. So Tuesday is when it would be.
I know later. I mean, it's a Saturday today. I've got, I think, 5 appointments today. I've got 2 on Sunday tomorrow, and I got to get all the work done. And then I'm totally booked out through Thursday, and then I have to stop to do the work. And this is not like we're so busy kind of thing. We're really having a hard time getting the work done. And this Prop 19 came out of nowhere. Howard and I were talking about him joining our firm when all of this stuff was happening. So for us, this is really happening real time. And we do really care about each one of you. And we do, we're like Howard, we really care about you guys. Even though we don't know you, we still care about you. And we want to make sure that you get the best possible legal counseling. And it's just really frustrating for us because, if this bill was effective, or if this initiative was effective a year from now, we'd probably still be a bit as busy, I would think, but at least we'd have more time to get the work done. Okay, so we've got, let's see. Is it still necessary to have a Q dot for a spouse who is not a U.S. citizen? I would say the Q dot hinges, first of all, it depends on if your spouse is a resident alien or not, which I'm assuming that your spouse probably is a resident alien. But, it depends on your assets. So it depends on the estate exemption that's in place at the time. And this could go up and down. It depends on what your assets will be. So the 3 things we don't know is, when are you going to die if you're not the spouse who's the foreign or the non-citizen spouse? We don't know when that person's going to die. We don't know what the assets are going to be, and we don't know what the tax laws are going to be. God knows all of those things. We don't. And if we did, we probably would live our lives differently as human beings, right? But my point is, we don't have that information. And so the only thing that we can do is we can plan as what the law is, and then think about what it might be, and then have some levers in there that we can pull to address that. But I would say that your Q dot, you might want to revisit that, because Q dots many times were written as like this mandatory, like half goes here and half goes there. But with the higher exemption, you may be able to have a formula in that trust so that it may eliminate or obviate the need for a Q dot, because when the citizen spouse passes away and the non-citizen inherits, you don't want to have to necessarily deal with a Q dot. And if your assets are under the exemption amount, you don't need it. So we got a lot of questions for transcripts. Oh, do you work with the designated executor after my death? Ian asks. Yes, we work with, that's probably 2/3 of our practice, is helping people after somebody's passed away or become incapacitated. So we can definitely handle that. What I'm going to do is it looks like we have no more questions. Let's see. Oh, Richard asks, in your introductory letter, you noted that our files will be destroyed after 90 days since the files were scanned. It depends on your original estate planning documents. We are not going to be destroying those. The other copies very well might be destroyed. So that's just something that we're working on. Howard had many, many clients, I think over 3,000 clients in his career. So we got a lot of paper to deal with. It's a big project, but we want to make sure that your information is secure. Richard says we would like the records if they're to be destroyed. Okay, thank you. And then we had some other questions here. I want to receive original documents for myself and my mother before they are shredded. And then we filled out a form online and haven't heard back. Yeah, this is what we've been talking about. We're just really busy. We will get to you, but it's very important. If you do reach out to us, let us know that you're a Howard Neal client, and then we will put you kind of at the front of the line versus all the random people that are reaching out. So I think that brings us to the end. Well, I think we've been here almost an hour and a half. I think I know I'm done. I don't know about you, Connor, but then we have one more. I have a living trust with my children as successor trustees and have my properties in the trust. Does this still need to be changed due to Prop 19? Millie, I don't know. If your kids are going to sell the property when you pass away, there's no need to do Prop 19 planning. If your kids are going to keep the properties, then it's something where you're going to want to consider doing some type of planning before Prop 19 becomes effective on February 16th. So with that, we'll wrap it up. Thank you very much for attending today, and we look forward to meeting with you. And please give us a little bit of grace. And we are very busy, and I know it doesn't matter to many of you. You say, well, they should be answering my phone. They should be answering their phone. What kind of firm is this? We have never been as busy as we have. And I'm telling you, every other lawyer that is worth their salt is equally as busy. And we will get to your matter. It's just going to take a little bit of time. Okay. So please give us a little bit of grace and a little bit of time. And we thank you for sticking it out here with us today. We look forward to meeting with you. Any closing thoughts, Connor?
Yeah. Thank you for joining today. We appreciate it. And we hope to meet you in person.
All right. Have a great day.
Thank you.